Obamacare, the Affordable Care Act, minimum essential coverage, exemptions, means tested types. Information designed by James R. Lorenzato and presented by Mark Lorenzato for VideoHealthGuide.com. This is video 5 of Series A. The last video covered the exemptions about who you are. This video covers 4 exemptions about how much money you make. The final exemption for no affordable coverage has several subparts and needs its own 2 videos. Some of these exemptions take a little math, and you must learn some definitions. Remember that exemptions are calculated by the month, and if someone is exempt for one day of the month, that person is exempt for the entire month. The idea here is just to give you the gist of what each exemption is about. We have included the major rules for each exemption, but remember there are many details. What you earn. You are exempt if you 1. Make less than 138% of the federal poverty level but can't get Medicaid in your state. That's not a problem in California. 2. Don't make enough household income to file income tax. 3. Claim a tax credit that puts your household over the income tax filing threshold. And 4. Have special circumstances that make getting coverage a hardship. Can't get Medicaid in your state. About half the states will expand Medicaid eligibility to 138% of the federal poverty levels for all classifications and for adults. In those states, people making less than 138% of the federal poverty level can't qualify for tax credits. Only those who make 100 to 400% of the federal poverty level can get tax credits. If you make less than 138% of the federal poverty level and can't get Medicaid solely because your state didn't expand it, you get an annual hardship exemption, even if you make over 100% of the federal poverty level and could get tax credits. You can get the annual hardship exemption only from the marketplace, and then you file the certification with the IRS with your tax return. The exemption can be retroactive for the previous calendar year. California is expanding Medicaid, so the exemption won't apply there. 2. Household income too low to file taxes. If your household income is below the income tax filing threshold, you are exempt and so are your dependents. You need to learn 2 new definitions for this exemption. Modified adjusted gross income, or MAGI, means that you start with a person's adjusted gross income under tax code section 62, which means gross income minus the allowed deductions, just like for income tax. 2. If the person excluded under tax code section 911, 26 U.S.C. 911, any foreign earned income that was made while working out of the country, you add that in. You add in any accrued or received tax-exempt interest for the tax year. So, if you didn't work overseas or have any tax-exempt interest, your MAGI is the same as your normal adjusted income for your income tax. Household income means your MAGI and the MAGI of each dependent you actually took an income tax personal exemption deduction for if that dependent also had to file an income tax return. Note that this is a different rule from the one who must comply with the individual mandate. For compliance, you count everybody you could properly take a deduction for, but here you count only those you actually took the deduction for and who must file their own tax returns. Household income equals your MAGI and spouses of filing jointly, plus the MAGI of each dependent who was required to file an income tax return. If a parent elects to put a child's unearned income on a parent's return under tax code section 1G7, the child is treated as having no gross income. Once you have added up your income and that of all dependents who file taxes, you compare it with your tax filing threshold under tax code section 6012. Depending on people's ages and other factors, the filing thresholds differ, but yours is a threshold that counts. If your household income is less than your filing threshold, you and all your dependents are exempt. Only the IRS grants this exemption, but you don't have to do anything to get it. You don't have to file a return for no other reason than to claim this exemption. If you do file a return for any reason, you can claim the exemption from the IRS with your return. Number 3, tax credit puts you over filing threshold. Some people who don't make enough to reach the filing threshold for income tax still file a return to claim a tax credit, like the Earned Income Credit or the Additional Child Credit. When the credit is added to your household income, it can put your income over the income tax filing threshold. When this happens, there is an annual hardship exemption available only from the IRS with your tax return. Special circumstances hardship exemption. There is a, quote, stuff happens, end quote, monthly hardship exemption when some extraordinary event prevents you from getting coverage. If, for a month or months, you have financial or domestic circumstances including an unexpected natural or human-caused event that causes a significant unexpected increase in your expenses, or the cost of minimum essential coverage would seriously deprive you of food, shelter, clothing, or necessities, or there are other factors like the ones above that prevented you from getting minimum essential coverage, you apply only to the marketplace for those months and then file the certification with the IRS with your tax return. This exemption makes you eligible to buy catastrophic coverage, but without tax credits. Next, no affordable coverage exemption employer plans. One more Affordable Care Act exemption for individuals. We viewed depending upon legal status and depending upon what you earn and can afford. Next is lack of affordable coverage, employer coverage. I hope this is helping. This is Mark Lorenzatto from VideoHealthGuide.com.